Today we'll be reviewing the controlling. Basically, controlling FI is for internal reporting, CO is for external reporting. Sorry, FI is for external reporting, CO is for internal reporting. Our CO is also for the managerial reporting, and FI is mostly for your financial reporting, external balance sheet, income statement, and your P&L, your taxes and all those things. CO is mostly for the managers, it's only for internal. And CO also gives you two things. One is the overhead cost. What is my overhead cost within the company, and what also my product cost for the goods that I'm manufacturing inside the company. Will give you that. FI will give you the financial balance sheet, income statement, and your cash flow analysis. Right? FI, it has to be mostly for the GAAP or your international accounting standards. But in CO, it's only for internal, right? There is no standards, so it's up to you to define how you want to report those things. Financial accounting, and these two are tied together whenever you're expensing something. In a FI, whenever you're posting an expense to something, system automatically will post something back to the CO. CO contains all of the accounting functions necessary for effectively running your controlling organization, right? So CO represents both the internal accounting perspective. FI is for external perspective. And then CO, actually, a lot of the managers use CO to make some business decisions. Hey, do I need to close this particular plant? Do I need to stop producing this particular product line? Do I need to stop opening a new branch in another country? So all those choices are based on data that you get from CO. And financial accounting is the primary source of data from CO. So anything that you post in CO, mostly the expense posting from general ledger result in a posting to the CO, right? We talked about anything that you expense. So I'll give you 3 examples. I'm getting a loan from a bank. Means my liability is going up. Okay, my cash is going up, and my liability is also increasing. So it has no bearing on the CO. I'm buying an asset at next point. So my cash is going down, the assets are increasing. It has no bearing on CO. I'm buying inventory, my cash is going down, inventory is going up, have no bearing on CO. So when you try to depreciate an asset, makes a posting to CO. When you try to consume the inventory, you start making a posting to CO. When you start paying interest on the loan that I got, it's starting to make a posting to CO, which somebody has to take responsibility of that particular expense. It needs to go into some organization. Okay, there are a lot of integrations to CO. One of the integration to CO is the logistics area. Logistics area has numerous integration points CO in the inventory area of the materials management. So whenever you do a goods issue, right, goods issuing for what? So goods issue could be for consumption, goods issue could be for production, goods issue could be for a specific order, right? I'm issuing the goods for something. Okay. So all those things have cost things. So if I'm issuing for production, this is going to say what is the production cost center. And if I'm issuing to a consumption, last for a consumption cost center, I can issue it to a small project. I can actually take the inventory and put it on a project budget. So any cost bearing object has to be, you have to have it for in logistics. So this is how system works. So you have your FI. FI uses what's called the primary cost element to make a posting into CO. And CO, whenever you're moving stuff within CO, system uses secondary cost elements. Means I'm making a posting to, from CO to CO, from CO to internal orders, from CO to project systems. So moving things around within CO, then I use the secondary cost elements. Primary cost elements, secondary cost elements. Primary cost elements, it is the one-to-one relationship between a GL account. If I have a GL account called travel expense, there should be a primary cost element called travel expense. If there is a GL account called my production cost, there should be a primary cost element called production cost. GL account called marketing cost, there should be an identical thing called marketing cost. There should be GL account the account here called salaries. This is a primary account called salary. Salaries to what? Salaries to the guy's CEO, then it's going to be overhead. Salaries to the guy who's fixing the thing, and then I know that it's going to be going into some kind of a service. So every year, so you have income statements, you have your balance sheet accounts, and the P&L accounts. All the P&L accounts have a one-on-one tie to CO. Whenever you make a posting, it automatically posts. Whenever you make a posting, it automatically posts. Same thing with the CO. So if there is an impact on the FI side, it automatically pushes things back to the CO. You look at the examples of when it goes this way, and when it goes this way, and when it goes this way, right? There are three ways: this way, and this way. Three posts. We'll look at some examples of all the three. Got this picture? And within the CO, there are so many different components, which I think is covered at the very top of that section here. So within the CO, you have cost center accounting, cost element accounting, you have internal orders, you have product costing, you have production order process, you have project systems, you have profitability analysis, and your profit center accounting. So you have all these things within CO. Okay, and it is actually a much bigger chapter than FI CO in the real world. But the good thing is CO, there are a lot of jobs when you're initially creating a project, but when the project is closed, there's not much. There is no lot of support. Once it's done, it's done. So, but there's a lot of support activities in FICO. There's not much support. If you go to large companies, there is nobody in CO supporting you because it's nothing to support. So everything is going to be in the FI. But when you're doing a project, a lot of initial customization we do it in CO. So look at that. This is a CO architecture, right? CO can be broken down into overhead, right, and product costing. Okay, so both postings are really coming from FI, right? Both coming from FI. We talked about work in progress inventory. We also have the existing inventory, and also we have financial assets that are actually being depreciated. The link between this guy and this guy is really your cost element accounting. We talked about primary cost element and secondary. Those are the ones that actually link this to these things. So if it is a cost, the cost better be this bucket or this bucket, right? Only two buckets of cost: overhead and your product costing. So in the overhead, you could have many types of overhead. It could be travel, electricity, executive salaries. It could be anything. In product costing, it could be material costs, or it could be the services costs, right? It could be two different things. And also there is a fixed cost and there is also variable cost, right? The fixed cost means what is the fixed cost of making a product. The variable cost is actually the material, how many components that you're actually making those things, right? And both of these things go up here to determine your profitability of that particular segment. So if I have only one product, if I'm making a phone, I only make one phone. So what is the overhead of this thing? How much did I pay for my rent of the office, electricity, salaries of the executives, insurance, whatever, with all the overhead, plus how much did I actually spend on creating? I made 100 products. How much did I actually be paid to make those things, right? This plus that would be your total cost. You made $100 million revenue, and let's say this is 50-50. You made $40 million overhead, $40 million production, it's $80 million. So you made $20 million gross profit. Right? It's kind of works. And then within the product costing, you have valuation, like how product costing means you have to evaluate. There are many methods of evaluating the material to truly arrive what is the true cost of the products that I'm purchasing. And also there is something called profit center account. That's where the revenue is kind of coming from. right? And then the profit is coming from the profit center accounting, cost is coming from these two. You put it back in the profitability segment, and you determine, slice and dice how you're making money. Okay, and this is all internal, right? There's nothing external, here. So over there, the guy is sitting, he's kind of slicing and dicing this data and saying, oh, this is not a profitable segment for me. I'm going to slice it. I'm going to enter into a much more profitable, product. And that's how they decide to close plants or, create new products or stop producing, old products. That's how we get the profitability analysis. Got it. The revenue side flows into, PC. PC flows into profit center, profitability segment. These two will flow into your product costing and any overhead costs, and then you go right here to the analysis. So a lot of the chapters in the overhead cost, we do the cost center accounting here. We do product costing here. We do profit center accounting here. We do profitability analysis here. So we kind of touch a lot of different things inside. Costing, errors between relation to noise, you work at product costing, the same thing we talked about. Okay. The purpose of the overhead costing is to capture costs that cannot be assigned directly to goods or services of a company. Okay. And anything is called the overhead cost. And allocate them as far as possible according to their cost. Allocation means who does this belong to. That's called allocation. As far as possible means a very good example is the salaries. Typically, when you pay salaries, everything comes from the HR cost center. After that, they allocate them back to, the production guy, the sales guy, the manufacturing guy, all those things. Okay, so if Ravi is my production head, and 90% of my salary is coming from his organization, if I'm a HR guy, and I'm going to push 90% of my cost, when I pay salaries back to him, this is your cost. Okay. And he's responsible to show profitability at the end of the day. And product cost, costing takes costs of the goods and services and settles them to financial accounting or profitability and sales. So these are basically cost of the actual goods and services. Okay. Our goes back to profitability. Look at those examples. CO, the primary cost of profitability and sales accounting is determination of the business profit and loss. What is my profit and loss? By what? By product line, right? This is not by company code. This is not by business area. This is not by the other FI architecture, right? This is mostly for the CO, so it's by product lines. You do have a P&L at the company code level, right? On the FI side, you can also do P&L at the segment level. You can also do P&L at the business area level. But on the FI side, you can't do business P&L by products. Only in the CO you can do the P&L by the products. Two views of product profitability. You can also do external view for markets. You can also do the internal view. So external sometimes also interested in how profitable are your products. Is your iPhone division profitable? Is your iTunes division profitable? Is your search engine marketing profitable? What people want to see, what is the most profitable product that you have. You can also create an external view for the market. In the CO side, when we talk about all these things, so we will go through internal orders is a small projects. Product systems is only for large projects. For the costing, both fixed cost, your direct material cost, services cost. We also look at profitability as profit center accounting is where your revenue comes in. Very clear on these terms, right? This is how the CO organization is structured. Most companies have just one controlling area and one operating concern. Within the controlling area, you have many company codes. Many company codes point to one controlling area. Okay? And all the business areas are company code independent, right? So many business areas can point to one company code, and your purchasing organization, this is on the logistics side, they point to company code. There are many plants, Plans are tied to purchasing organization. Plans are also tied to company code level. And sales organization go back to the company. So controlling area is really what will show me all the companies that are doing this reporting, right? So ExxonMobil, for example, could have 100 company codes all over the world, but they want to combine those things in the top level at the control because he wants the global picture of how their products and things and services. Controlling is a basic organization in CO. Controlling it is closed entity for cost accounting. Costs can be allocated within the controlling area. And blah, blah, blah. Company code, we already know all these terms, right? Company code, business area plan, we already know all these terms, okay? Cost element accounting. Cost element is that part of the cost accounting that involves in the recording and classification of the costs. Means what type of cost do I have? How, at what granularity do I want to manage my costs, right? Travel, marketing, salaries, computer expenses, whatever you want to classify the cost, you want to have that in your cost line, in your P&L. Same thing, right? On your P&L and your same thing, they're pretty much identical. At what granularity that you want to do those things. And this is exactly on the accounting system, but kind of reflects exactly how the P&L. And also any settlements back from CO to FI. Cost element is a CO equivalent of FI, and it has both the primary and as well as the secondary. Primary cost elements are exactly the P&L accounts, okay, identical, one-on-one. One P&L account corresponds to one primary cost. Secondary cost elements are CO accounts used to transfer costs between the objects without impacting the GL. Okay? If it has an impact on the GL, then you don't use a secondary, you use a primary cost element. And there's another picture here. So all the P&L accounts have a one-on-one correspondence to primary. FI is tied to CO by that, right? Your AP is tied to FI using reconciliation account, right? Same thing. These two things make them in sync. So the total of P&L should equal to total of primary cost at all times, right? So that is called the CO FI reconciliation. Your FI side is telling your expense is $100 million, but your CO side is telling your expense of $90 million, you're in trouble. There's something wrong. So these and these should match. Secondary always stays here. Balance sheet always stays in the FI side. Balance sheet has no impact to the your CO. Right? Got this picture? Okay. Types of secondary cost limit. There's settlement cost. There is allocation cost. Settlement cost is used to allocate orders or projects to other cost elements. You're settling projects to a cost center, right? Means you have a large oil rig and you have $1 billion budget for the project, and once the project is done, I'm going to transfer that project or as in pieces to the owner who's responsible for this. Ravi, that's a CIO. So initially, CIO made me a project manager. He gave me $1 billion. I will do this complete project, okay? And then once the project is done, I'm going to hand that over to the operations guy. Okay, I'm going to settle that back to the cost center owner. And also there is settlement cost and allocation cost. And currently the amount allocation based on the allocations are mostly based on activities, hours worked. So I need to do the activity allocations within the cost element. Right? So activities could be hours work, could be SQAs, and, production orders, and settlements and allocations. Look at all those terms later. Cost element types. For the secondary, there is an assessment cost element, and assessment cost element distributes the cost from cost center to the other cost centers. Okay, they're making the assessments and moving from one cost center to other cost center. Okay, another example here. right? Same thing, same concepts. There's a balance sheet side, there's a P&L side. Anything that's in the P&L side pushes to CO, and within CO they get moved around, right? They get the costs get kicked around. It's like I gave this guy there's one bottle of water, there's another bottle, there are 3 bottles of water, right? So you're moving things. Water is the expense, the cost, right? So moving things from one bucket to another bucket. At the end of the day, the sum of all the things should be the same, right? You're just moving things from one to another. Cost center A to B to C to whatever. Each one is the cost, but the total should equal your total in the P&L. Yes. So, it's pretty common to take months, years to people. It's like a ball, kicking that around. Okay, it's not mine. It's not mine. It's not mine. People are kicking that around. So ultimately, it's going to end up in a place where it needs to rest. Okay, it needs to go back. Secondary, things are moving within the cost centers, right? Moving from here to here. So initially I expensed salaries, but after that, as once it goes to the HR cost center, I'm moving it to marketing cost center, sales cost center, IT cost center, production cost center. So it has no bearing on So I'm just going to move using a different account. It could be a 9, typically anything that start with a 9 accounts, the last number in the GL account, typically those are called the second. Those you mark them as secondary cost element accounts, and they have no bearing. So you exclude them in your F5 accounts. Any secondary accounts. And then we get into cost center accounting. Cost center accounting basically is who's absorbing the cost, right? Cost center is an organization entity within a company. It could be a plant, or it could be a quality inspection operation within a plant, or it could be an IT organization within the plant. Who is absorbing the cost? That's primarily your cost center accounting. Cost centers provide a means to track the actual cost by the manager who's responsible for it, right? I'm a production manager, I'm an IT manager, I am a HR manager, I'm a sales and marketing manager. And everybody in organization entity will have a cost center assigned to them, and that's the way they can track the cost assigned to your organization. Cost center can be grouped together in a hierarchy. Cost center can be planned, and you can compare actual versus plan. At the beginning of the year, I gave you a budget of $100 million. You can track the actual postings throughout the year for your operations. Key terms controlling area, we kind of looked at it. Company code, we don't need to worry about it. That one. Cost center is the organization unit within the controlling area that represents a separate location of where the costs are incurred, means who spent the money. Activity types are part of the cost center account. The activity types categorize a production or a service activity. Is it related to rendered to a cost center? Describes the activity that's performed by the particular cost center. Okay, it could be how many hours an employee worked. It could be how many laptops have you consumed, how many machinery that you purchase, anything, any units. It could be quantity, it could be hours. So what is the activity type of a particular cost center? And then this kind of has a lot of bearing on actually determining the cost in the your product costing and all those things. Let's take a quick break. Okay, we'll start the recording again. Assessments. Assessment, the term means you're transferring costs from one cost center to another cost object. Okay, anything, any assessing, you can transfer from cost center to internal order, WBS element, any other cost object. Costs can be transferred or summed up are an assessment secondary cost element and posted to the relevant cost object. So assessment always is a secondary cost. If they're moving from cost, one cost object to another cost object, right? So you're doing assessments on those things. Segment is an element of the assessment cycle defining the to object, okay, and which object and how the costs are transferred. So how are you transferring from the to the other things? You can group the segments by, is it a G&A, is it marketing, is it sales, is it which segment are you kind of concerned about? And always in the CO there is something called the assessment cycle. Assessment cycle is always a group of segments, means which group are you trying to run, is it G&A, is it sales and marketing, and you do the assessment, means you're transferring the costs, reposting it to from cost object to the receiving cost, assessment cycles. So assessment is one of the activities during the month end. You run the settlements and then you do the assessments. Assessments means you're moving from one bucket to another bucket. And then there is always a sender who is sending from, and also there is a to, okay? And also there is a tracing factor rule to transfer the cost to receiver. Is it a fixed amount? Is it a percentage? Is it, what percentage? You can always create an assessment cycle every month. The HR guy is going to transfer 10% of his costs to 10 different departments, right? It's a percentage basis, not a fixed amount. You can also do fixed amounts also. But most of the time it happens to be percentage basis. So I paid my salary, my cash went down. Initially I expended the P&L to the salaries. Salaries is basically your P&L account. All went to the HR cost center, and then run my assessment cycle, moves 10% to all these 10 different costs at the same time, right? All internal after that. And there is a fixed 10% basis to move to 10 cost centers, and HR guy is completely relieved of his obligation. Same thing, the IT assessments, right? So IT department always pays for all these things, to the wireless routers, to the laptops, computers, and then since it is not mine, okay, and he spreads it to the other departments. Same thing, that the overhead, the rents, the electricity, all those things are spread to other organizations. And there's always a posting date, document date, and entry date when you're making assessments. Cost center definition, again, we looked at many times. The lowest level where people are taking financial responsibility, where the cost of incurred, the key term, where the costs have incurred, okay? Remember it, where the costs have been incurred. Assigned to a cost center group, again, when all the cost centers can be assigned to cost center groups, and the groups go back to the top level hierarchy, cost center hierarchies. Cost centers have characteristics. Cost centers can be linked to a controlling area, obviously, and it have a standard hierarchy, and also have an indicator on the cost center allowing the blocking of the revenues. Means you can also track revenues in the cost center also. You can track expenses, or you can track both. For the most part, all those things are checked. You do track revenues and expenses at the cost center level also, and the profit center level also. Cost center numberings, I mean, it's up to you to determine. You can have 6-digit, 4-digit, 3-digit. You can kind of have n-digit numbers. Cost center numbering. Cost center can be up to 10 digits. Cost center must have to be a unique number. We'll look at some examples, and typically cost centers have a hierarchy. So lowest level is the 4120. This is the hierarchy at the higher level, and this is the hierarchy at the very top of the chain. So within the services, you have technical services, technical facilities, and the very top you have technical area. And then same thing, within the marketing, you can have marketing and sales for U.S., Canada. Within the U.S., you can have Texas, you can have Michigan, and within Texas, you can have by county and by region, kind of broken down by plant, by region. Okay, activity types define the specific activities provided by the cost center. Activities, say, for example, salaries could be one of the activities. How many hours? There could be, there's another type, overtime, right? Another time of this activity could be how many hours does it take to fix a particular machine. So they're all activity types. An example is an employee assigned to an activity type. Is it per hour? Direct allocation is entered for 25 hours and charged to project X. And project X will charge $2,500, right? It took him 25 hours at a rate of $100 per hour, and the cost would be $2,500. So kind of, even though you paid the guy $2,500, kind of breaks it down into what is the cost per hour. So you can kind of track, look at a Toyota, hey, am I paying overtime for my employees to assemble a car? How long does it take me to assemble one car? These are all the key metrics for a lot of people. How many kilowatts of electricity am I using in that particular plant, right? A lot of metrics that you want to measure. How many barrels of oil, how many, not barrels of oil, how many gallons of drilling fluid did I use in this particular operation? So anything that you want to measure, you can do that. How many computers did I use on this IT project? In the activity types are mandatory in terms of short description. The activity unit is an hour, and the cost center category allows you to restrict activity. Look at the what category it is, and the allocation cost element. Cost element is typically, we talked about, right? What is the cost element category? Type is typically 43 is for internal activity. The different types of activity cost element categories or cost, also cost center categories. You can also have activity type groups. So just like the cost center groups, you can also have higher level activity type groups. So you can put in all the electricity repair, fitting a bulb or doing a wiring or installing an electric circuit, right? All those things could be in a group called electric services, something like that. Anything production, welding, fitting, piping, assembling, all those things be production activities. You can kind of group them into higher level activities. In this CO, you have a lot of groups, right? You have cost element groups, cost center groups, activity type groups. There's a lot of everything at the bottom level. Group is higher because all reporting in the CO side. And also do the activity price planning. So you have to establish the initial activity prices at the very beginning. How much does it activity really cost for the budgeting process? They can always redefine or readjust those things. And another metric is the SKUs. SKU is the activity is the hour. How many hours is defined in your statistical key figures. Statistical figures are usually calculation in the informations on a periodic basis. It is the actual number for that activity type. Statistical key figures may be assigned to one of the two. There is a fixed value, valid for posting period through all the following periods, and there is a total value. Total values are valid in the relevant posting period only, and new posting must be made in each new posting. Okay. So an example of a key figure is a statistical figure is an employee. So how many employees I have, how many hours. The exact hours would be in your SKUs. Key figures used to create the reporting the personal cost for each employee and distribute the costs that are incurred by the cafeteria, cost center, or other cafeteria elements. These are all the master data reports. So if you want to report all the cost centers, use KS13, cost elements K23, activity type scale 13. You also have the statistical key figure, KK, 04. So let me kind of show you